Well, thank you for joining me for the weekly update. Well, let's get right into it. First and foremost, the clay shoot's coming up next week. The prize table is full, registration just about. We're looking forward to getting out there and blasting some clays and raising money for MS, but that'll be next Tuesday. So if we're a little slow to answer the phone that afternoon, cut us a little bit of slack. If you have questions for future installments, go ahead and make sure to send them here. And with that, let's get into this week's question. So given the market seems to be hitting all-time highs and the bond market isn't giving us the returns we want, where else are we looking for consistent returns? Well, yes, the market is at a lot of new highs yet this year. Many. There's been a little bit of shakiness in the past week or so, but a lot of new highs in the past month even. The bond market, I think year to date, the bond market is actually slightly down. I think it's down like 0.25%, which people buy bonds for yield and to make a little bit of money consistently, and that doesn't feel like that's happening right now. So where can you look for consistent returns? We talked before about private equity, direct lending, private real estate. But there's one other solution we often look to, which is market-linked investments or structured notes. They're commonly interchangeable terms, and I want to talk a little bit about how those work and the general idea behind them. First and foremost, they're bonds. We tend to lend money to a large financial institution for a set period of time, and they pay us back based on how a agreed upon index does and the terms surrounding that index. They're all initial public offerings. Each one is different. There are long prospectuses, but they're fairly simple to understand once you get the hang of them. What do you buy these things for? Well, these three key terms. Capital preservation, don't lose my money. Risk managed growth, I want to keep growing, but I want to take less overall risk, and I want to try to outperform when I get the chance to do it. Enhanced income, well, I want to make more money on a more regular basis. So let's take a look at two primary examples of how these things might work and what that might look like. So the first example, we lend money to a financial institution typically for a set period of time. And everything you need to know is at that top of the box. And some of these terms aren't going to make a lot of sense, but I'll walk through exactly how they work. First, the underlier is the S&P 500. Term is 4 years. There's a buffer, meaning a protection provision of 20%, participation rate of 1.2 times, and a market cap return of 50%. So what happens? Well, the market goes up and down over that period of time. But at the end of 4 years, at the end of the term, that's what's important here. Only at that final 4-year period, there's only a couple of things that could have happened. Right? The market went up like a hockey stick. It was up 60% over that period. We're capped out at 50% return. That was one of the original terms. The market goes a little bit more sideways and is only up 30% over that period. We outperform. We're up 36% because we're up 1.2 times 30, the return of 30. That's 36. The market declines during that period, goes down 15%. We get the return of principal. We get 100% of our original investment back. The market declines greatly. It's down 27%. The buffer comes into play again, that protection, and we're only down 7%. So the first 20% is on the issuer. Why do you buy something like this? Well, if you're looking for consistent returns with the markets more sideways, this is great because you tend to outperform. If the market's down, you outperform. If the market's up like a hockey stick, you participate. So if you think the market's at all-time highs and you're a little bit nervous that the market might be set for a decline, well, in basically 3 of the scenarios, you end up doing pretty well. If you think the market's going to go sideways or decline, it's only if the market continues to shoot upward that you could possibly lose out. But again, you still get a big portion of those gains. Why would you buy something like this? Well, frankly, in almost every year of my career, 2012, 13, 14, I mean, except for maybe 22, everybody told me the market was near the highs and couldn't keep going up. And many times that seemed to be incorrect. Well, yeah, people told us the market was topping out in 24 and 25, and here we are in 26 hitting new highs. So this is a way to keep participating, maybe not fully, but still participating a lot, participating very, very well if it goes sideways, and protecting ourselves on the downside. And it's a great alternative to maybe getting very bearish and going all to cash, in which case you can have that FOMO or fear of missing out as the market keeps rising. Here you are still participating, but you are taking a less risk overall. The other way to use these, and there are a lot of different types of terms for market-linked investments. Each one, again, is its own It's its own IPO and its own set of rules. Another common one is to try to enhance income. So again, I'm going to read some terms out. They might not make a whole lot of sense, but let's walk through the different scenarios. The underlier is the S&P 500 and the Russell 2000, the lesser of the two. It goes for 3 years, protection rate of 30%, and a coupon contingent of 6.2% per annum paid semi-annually. The lesser performing underlier above 30% coupon bearer. So what happens in this over time? Again, the market goes up and down. Right? There are some check marks at the bottom, there are some X's at the bottom. If either index declines more than 30% on that anniversary date where you should be paid your coupon, and it's below that, we don't get paid. So we miss out. How often does that happen? Back testing does not guarantee future results, but it's in excess of 99% of the time that doesn't occur. So most of the time we get it. We get the coupon, we collect it, and at the end, collect our final coupon and we get our original principal back. Now, again, why would we do this at 6.2%? Well, because investment grade bonds aren't paying nearly that well. High yield bonds are paying about that rate, and we're taking a similar risk to high yield bonds at 6.2%. But if we look here, the two scenarios, at the end we get the final coupon payment. Hopefully you don't miss any coupon payments. You get paid better the whole time. And we get our principal returned at the end. In scenario 2, we forego the last coupon, and if we've broken below that 30% barrier, like the market's down 35%, we're down 35%. So it's a pretty rough realization. It's also why you want to have these things laddered out in long periods of notes. But why would we do this? Well, when this presentation was put together, 6.2 was a reasonable example of this note. Today, notes very similar to this are yielding more like 10 and 11%. And if I can get 11% every single year, as long as the S&P doesn't fall 30% on the anniversary date from when I initially bought it, that seems like a fairly positive bet. I mean, how often is the market down 30% even 1 year later? The answer is it's happened a couple of times, but it's not that common. Even COVID, that wouldn't have happened. Even if you bought it at the bottom of COVID a year earlier, the market was almost at the same level. So it wasn't 30% below that. Even if you bought it in February, of 2020, the market might have fallen off 34%, but you had 1 more year in which the market again recovered and you would have gotten the full coupon payment. So it's a way to enhance the income over time. And if we can collect, 8, 9, 10, 11%, as long as the market doesn't drop 30 or 35% in many cases, it's a very positive overall risk trade. So one of the challenges I have here is I'm doing this in a short format. Below is a link to a much longer format of exactly how market-linked investments work, a much broader explanation of how all of these things work, different types of notes, different understandings of the intricacies of them. I encourage you to go watch that here. With that, I'm going to close out. Our book recommendation is, again, 1929. We're looking forward here in a few weeks to recommending a new book. And thanks everybody for joining us this week, and hopefully we'll see you all at the clay shoot next week.